All right, so um, this morning I want to look at a trading psychology video. It's a short video, it's about 10 minutes. And then I want to kind of go and talk a little bit more about the psychology. So without further ado, I'll play this video.
You know, when I was young, I grew up in a fairly strict house, always knowing right from wrong, and for the most part, always been able to decipher what I should or should not be doing. And now that I'm a parent, I realize that having and enforcing a set of rules is an extremely important part to an orderly and functional household. And any trader that wants to make it for the long haul must also have a strict set of rules and make sure we stick to them. Because at the end of the day, what good are rules, even if we break them maybe 2 to 3 times a year? You know, there's nothing worse to me personally than taking a loss in the market that can wipe out weeks or maybe even months of trading. You feel like the last several weeks or months got simply flushed down the toilet. You know, you spend day in, day out grinding out wins, grinding out trades, only to have everything, be wiped out. It can be mentally demoralizing and very hard to get your mind back on reset. You know, it's the financial part of the loss that hurts the most, but the mental and emotional part can be just as bad, because if you're not trading with a free and clear mind, you may as well go home. That's how even some great traders can get caught up in a vicious cycle. Once the losses start, they almost don't know how to get themselves out of it. That's why I think it's so important to try to stick to your rules and limit your losses. You know, one of the great benefits of being a trader is that we're our own boss. We work from home, and for the most part, we answer to nobody. It's really everybody's dream job. But, on the flip side, there's nobody there to hold us accountable. So let's say we all were to work for a company. It doesn't matter whether it's big or small. And 2 to 3 times a year, we bend the rules. Or 2 to 3 times a year, we just make that same mistake over and over again. And we cost this company tens of thousands or possibly hundreds of thousands of dollars. What would that company say to you? Most likely you'd be out of a job. That's why it's so important, as self-employed individuals, traders, we hold ourselves accountable for our actions. Now, as a trader, I realize the most important thing I can do on a daily basis is preserve my capital. Taking excessive risk, taking on marginal trades, or adding to losing trades is an easy way for losses to add up. Sometimes as traders, we're always focusing on the next big setup. How much are we going to make on VERI? How much are we going to make on this? How much did I make last week or last month? But how often we focus on what we're doing poorly? How often we focus on our losses? I think our losses can be a great tool to help us create some rules. I think our losses, can help us study and say, hey, this is what I don't want to do again. This is what I don't want to do in the future. The thing about trading, it's a very tough profession. I think the stats are something like 90 to 95% of traders fail. And why do they fail? They don't fail because of a lack of winning setups or lack of wins. They fail because of their losses. They fail because they just take too many losses too frequently, or just that one big loss. I mean, that's the thing in the market. One loss can wipe you out and end your career. That's where a good set of rules can either make you or break you for the long haul. Now, trading can be a difficult profession. For that, we sit in front of our computers all day long, and we feel unproductive if we're not always in a trade or pushing buttons. We follow traders on Twitter who tweet a new idea or ticker every 35 seconds. And we say, hey, that guy trades 80 to 90 tickers a day. I need to do the same thing. No, I think that's BS. I think you should not do the same thing. I think you need to stick with your high probability setups, the setups you're going to be profitable on. I'd say at least 75, 80, hopefully 90% of the time. Now, sometimes it can be hard to sit on your hands and be patient, wait for those setups. But why chase subpar setups? Why chase boredom trades? Why put good money after bad? Now, how many of us here of traders have followed a chat room, a Twitter, or a friend into an idea that we knew was not a high probability setup for our own trading style? Now, we all have different trading styles here. What works for you may not work for me. Personally, I'm a terrible long bias trader. If and when I ever do go long, I take profits extremely fast, knowing that a lot of times profits can just get away from me pretty quick. I don't have the patience nor the conviction, to hold them. That's why month after month, year after year, I personally get more strict about the trades that I place. I probably place half the amount of trades I did maybe just 5 years ago, but I make way more money. Why? Because I trade the high probability setups that I know I'm going to be profitable at 80 to 90% of the time. I like to use size with those trades, and I have very strict rules when it comes to cutting losses. Now, I'm sure most of us as traders have rules, or at least we should. How many of us use stops? I mean, stops are a must. I mean, we all have to use stops. Now, I personally rarely use hard stops, but I have mental stops on every position that I take. Basically, if something's breaking support or resistance, I usually just exit that trade. And I think most of us here need to have a mental idea in our head of where we're going to exit a trade based on where it goes against us. How many of us here have ever been in a losing trade and we're down something small, maybe $5,000, and we think, oh, I'm not going to cut it. I feel like this is going to be a winner, and we add to that trade. An hour later, we're down $20,000 to $30,000, and we think, wow, it's hard to, I can't cut it now. We hold it to the afternoon. Maybe tomorrow it gaps up. We're down $70,000, $80,000, $100,000, and we think, what the heck just happened? I mean, I could have cut that loss yesterday for 3, 4, 5 grand. Now I've given up 10, maybe 20% of my year just by being stubborn. Think about how much more money we could make at the end of the year if we just stick to some simple rules and cut our losses at an appropriate place. Now, for me personally, I very rarely enter a trade, unless it's with starter size, something really small, unless I know I'm going to be in the money immediately. I asked the question, why would you ever enter a trade knowing it's going to go against you? And you say, well, I'll just add higher. I mean, why would you ever want to do that? I personally like to be right on my first entry. And if I'm not, I cut it and I look for a re-entry. The last thing I want to do, again, is be stubborn, refuse to cut a loss, add to losers, and before you know it, you've given up 10, 20, maybe 30% of your year on any particular setup. I see so many traders that can consistently make money month after month after month, only at the end of the year realize they were stubborn on 3 to 4 tickers, and they gave up, maybe 20 to 30% of the year. Now, let's talk about being stubborn for a minute. Why is it that we refuse to cut losses? Is it that sometimes we refuse to be wrong? Or has the research we've done on any particular stock made us so overly biased that we think the market is wrong and we are right? Or did we possibly take on too much size overnight on a low float stock that's opened dramatically against us? There's numerous reasons we take losses in the market, and a majority of them are our fault. We can say, well, Dries was manipulated when it went from 5 to 115, or KBIO was a fluke when Shkreli bought it and went from 2 to 40s within a couple days. And those are true. I mean, Dries was manipulated, but at the end of the day, nobody forced us to hold Dries. From 40 to 60 to 80 to 100. Nobody forced us to hold KBIO. Some people added after hours. Some people added the net, a few days later. I think at the end of the day, our losses are they're basically our fault. I mean, sure, there can be unexpected news or events, but at the end of the day, I think it's our stubbornness that leads to some of our biggest losses. Now, I personally have a lot of rules in my trading. I've already went over a couple of them. Most of them are just ingrained in my head. I know I'm just like walking, talking, eating, and sleeping. I don't even have to think about them. But I'll go over quick, a couple of my top rules again real quick. I like to trade the best setups out there. Setups that I know I'm going to be profitable on 80 to 90% of the time. And I like to use size with those setups. I ask a question. If you see a setup and you say, hey, 9 out of 10 times I'm going to make money on this setup, why would you not want to put big money behind that trade? Why would you not want to? I think the risk reward is definitely on your side there. I think, for me personally, the big money's in the big wins. I'm not going to get rich scalping. It's just not for me. And I certainly know I'm not going to lose money on boredom trades because I just don't play them. If the setup's not there, I sit on my hands. If not, I'll just leave for the day. I never feel forced to trade. Second, never, ever add to losing trades. There's a reason the trade is going against you. You're wrong. I mean, it's all there is to say. You need to exit that trade and look for a re-entry. And don't ever say to yourself, it can't go higher. I mean, it can't go higher or it can't go lower. For anybody that says it can't go higher, put a chart of Dries next to your computer from last November. For anybody that says it can't go lower, put a chart of Dries next to your computer from November 15th to a few weeks ago. It's down 99.99%. There's a prominent hedge fund manager out there a few years ago that was bullish on Valiant. He was bullish in the 200s, bullish at 180, bullish at 150, bullish at 100, bullish at 80, 60, 40, 20. I think he finally sold at $10 or $15. Why? I mean, it's just stubbornness. And that's all it is to it. It's just stubbornness, in my opinion. Third, take profits on winning trades. You know, I always scale out of positions. Let's say I'm short 50,000 shares of a position and it's reached maybe 70% of my target. I like to take at least a third off right there. Always locks them in. Falls another 10, 15, 20 cents, take another 10, 15,000 shares off, whatever it is. Don't ever try to be so stubborn to try to pick the exact tops or bottoms. Another one is always trade with a free and clear mind. You know, I've noticed that if I don't sleep well, maybe had a traumatic event in your family, whatever it is, it's just best not to trade. And don't ever trade if you feel obligated or forced to make money. You know, if you had a big loss last week, don't ever revenge trade. You know, you really have to have a free and clear mind to trade in the markets. The biggest one of all, and lastly, is cut losses, cut losses, cut losses. You know, I think as traders, if we can create a good list of rules with strict stop loss management, I think at the end of the day, we can become more profitable traders. Thank you.
All right. The video is something that we all know, but you know, I think it's important to go back and hash those subjects because for a long time, you know, I kind of struggled with a grade A setup or a surefire setup. Do you guys, can you recognize a surefire setup or a grade A setup on a chart? Anyone?
I'm not sure if I can recognize a surefire trade setup that I automatically know that it's going to win, if that's what you're asking.
That's exactly what I'm asking.
Oh,
Thank you.
I
So-
recognize a trade that's going to win, but I don't recognize when a trade is going to go above and beyond my expectations of
Well,
going further than my TP.
It,
So I
it
could
doesn't,
have
it
got
doesn't have to go through your expectation. It can just do exactly what you think it's going to do. This is very important and it's really underrated in trading. When you go to enter a trade, you know, there are some trades that you enter and you say, well, you know, this could go up or it could go down. But there are other trades where you enter and you say, I know this is for sure buying or this is for sure selling. Can everybody identify those for sure trades? If you cannot, then this is a huge problem with your trading, and it will be a huge problem with your trading forever until you can identify that for sure trade, that 100% winner or that 100%, you know, loser or whatever, you know, like, or you know, 100% buy or 100% sell, you know it without a doubt. So let me just go to the charts and I can show you exactly what I mean, right? So everybody's been enjoying the little JPY run, right? Where did this run come from? It's kind of a rhetorical question, but if you go to the monthly chart, right? If you go to this monthly chart, you can see these last 2 months, the JPYs have been trending down, right? Big momentum candles going down. We knew we can expect a retracement. You know, I thought that it would retrace and touch both of these moving averages, but it didn't. That's not the important thing. The important thing is that the momentum is continuing downward, right? So if you have a monthly chart, or I'll actually go to the one with go to one within order block, so you might be able to appreciate it a little bit more. AUD, JPY, which one of these jokers had it? Okay. So if we're looking at this pair, you know, this is a 2-month valuation. And I did this, I think, Leandra, we might have looked at this at one point, you know, before the start of the new year, right? Or maybe was that
yeah. I think
so
well, we have JPYs.
what I like to do is get a long range view of the market, you know, and this is how I look and see like what the market is going to be doing in the future. So if you look at AUD JPY, You know, first of all, if we pull this chart out, we can see a pretty good pattern here, right? The market comes just like this. And if we just copy and paste this pattern, we can probably just go on across here, right? We know that the market came up and hit this high, it came down, it came back up and gave us a little bit lower high, and now it's pushing down. So this is a 2-month, these are 2-month candles. November gave us a bearish order block. So for the next 2 months, we can probably expect this thing to keep pushing down, right? So that's my generic expectation, is for price to continue to push down. Now, when I go and look for my entries, you know, I can just drop down time frames to where I can see something that makes sense to me as a trader. And if I go from 2 months to 1 month, and I have this long bearish momentum candle, I knew that this was going to retest right at the first of the month and then start pushing down the rest of the month, right? So here we are, January 14th, we've already retested and we're beginning our push down. And we go down to the weekly, it even clarifies it more. You know, we had a bearish order block back in November, price pushed down. This is our first bearish order block on the weekly chart, you know, in January. What does that mean? If I drop 2 time frames down from this weekly chart, not the daily, but the 4-hour, and I wait for a bearish order block, this first bearish order block that's going to show up on this chart, that's going to be my gold trade. Like, there's not a question in my mind that we're going to tank off after that, right? Once I get that bearish 4-hour order block, what I do, once that candle closes on that 4-hour bearish order block, I can drop down 2 time frames to the 15-minute. And now I'm looking for the first bearish order block on the 15-minute. At that point, I can go heavy because I know it's cooking, right? That's a for sure trade. That's how I get my for sure setup. It's all those order blocks lined up in the same direction. And now I'm on the 15-minute. And once the 15-minute gives me my bearish order block, that thing is going to cook. It's going to sell off, right? And at this point on this 15-minute chart, in fact, let me go back to the weekly. Because on this weekly chart, I have a bearish order block and I have all this room down here. You see the wicks down here? The lowest wick on this weekly chart is at 214 pips. We got a bearish order block. This is a guarantee. This is going to hit right here. Price will hit this low. That's how Smart Money Concepts is. Smart Money Concepts says the price comes down, comes back and taps in, you can at least trade it back to equal lows. Here's your equal low. Here's your target. Right? This is your target on the weekly chart. So I know whenever I get that 15-minute order block, I can trade this down. Now, this might be my initial target on my 15-minute chart, but this is the prize. This is the goal. So I can trade this with confidence down to this area. Now, I might not need all of it, you know, for my percentage or whatever, if you're trading to get you a percentage. But this should be like a big joker guarantee that you're going to trade this down to your price with confidence. Even when it pulls back, you know it's coming at least this far. Does everybody get that?
Yes.
Yes.
So that's what I mean when I say your grade A setup or your sure setup. You know, whereas other setups that you might not be so sure in is when you get your order blocks and they're up against, you know, a moving average or in the middle of a zone, and maybe it was just a retracement, and it's not actually, the market is not actually going that direction. And what I mean by that is, as we're pushing down here, if we get a bullish order block that's just retracing back to your moving average, that's not saying that the market is going up. The direction of the market is selling. So that's not a grade A setup. You know, that's just price. This bearish order block on this up move is not a good setup to sell. It's just retracing to your moving average and allowing you another buy entry to buy it up. Right now, the market is double topped, gave you a bearish order block and started selling. So now we're just looking for sales on the way down. So your grade A setups, your surefire setups, should come with a backing, right? They're going the direction of the market. Your order blocks lined up. You should feel very, very comfortable about selling this pair or any of the other JPY pairs because they all look the same. Does everybody get that?
Yes.
So that's what I mean
Yep.
by a surefire setup, a grade A setup. If you don't know or you don't have that, that's going to hurt your trading. And just because I talked you through what I like to see doesn't mean that you actually know it. So you have to go back and spend time on your chart, you know, looking at your setups and your trades that you've taken. That's the important thing about the trade journal. If you can go back and look at your trades, was it a grade A setup? Like, I know you might have made money on that trade, but if you don't know why, you can't pinpoint why you made that money or why it ran so great, then you're going to be at a deficit still because you can't repeat that. Like, you need to find something that you can wash, rinse, and repeat, right? Like, we trade the weekly order blocks, and that's all cool, but you need to be at a level to where you can go and look and see when your run is going to start, like when that trade is setting up. And all of that is going to take you back to, you know, what session that you can probably expect to see the trade run, and then the timing, you know, it's probably going to be at the beginning of that session, or, you know, at sometimes if you catch a Judas swing, it might be, you know, in the middle of that session. But once you see the chart setting up, you'll understand when you can expect a bigger move from those pairs. You guys tracking?
Yes.
Who does not understand what I'm saying?
You're saying like once you see the chart setting up from the 4 hour.
Okay, so it's not just one time frame for me, TT. It's several time frames lining up. And when I talked you guys through, I was talking from this 2 months time frame. Like, so I'm gonna get Selena or golly, man.
Leandra.
Yeah,
Yeah.
Leandra.
Oh,
When we had that talk, or when we were talking about these 2 out, y'all, do y'all remember what date that was?
It was New Year's Eve.
mhm.
Okay,
Yeah.
so
Yeah, I couldn't leave.
okay, so New Year's Eve, we were looking for what direction the market was going. Like, what you need to know as a trader is what direction do you need to trade? That gives you some sort of an advantage, right?
Mhm.
So there's no need for me to look for buys if I understand that the JPYs are going to be pushing down. That gives me an advantage. Okay, so I need to be looking for sales. So when you start dropping down time frames, right? I go from 2 months to the 1 month.
Mhm.
What do you want to see on the chart?
Bearish order block or
Right.
confirmation of that it's going to sell.
There you go. I don't see a bearish order block, but I do see big bearish candles, right? So I think I can keep dropping. Now I drop down to the weekly. Wow, there's my first bearish order block, right? So if I go from 2 months, if I have a bearish order block on a 2 month, my signal is on a 2 month, where's my entry at? 2 time frames down. There's
Weekly.
1 time frame, 2 time frames. So I could enter Sunday. I can just enter for a sell based on this setup. That's a grade A setup, but this is a grade A setup for like a position trader, you know, because this is going to be for weeks. You're going to hold this for weeks.
2 months, yeah.
Yeah. Because it's based off that 2-month chart. So that tells you as a trader that for the next few months, the JPYs are probably going to just trade down. They're going to retrace, but they're going to be trading down. So that gives you your bias. You get that, TT?
Yes.
So now that you have this signal, this is a bearish order block on your weekly chart. Where do you want your entry to be? You want to get your entry from where?
The 4 hour.
4 hours.
2 time frames down, the 4 hour. So once this week starts and it gives you a bearish order block on your 4 hour, that's your entry signal, right? You get that?
Yes.
Okay. So to take that one step further, once you get the 4 hour bearish order block, what I like to do is drop 2 time frames down to the 15-minute and wait for that bearish order block. And that's go time. That's when the money is going to start blowing it. As soon as you hit that 15-minute order block, it's going to start selling and it's just going to sell. You tracking?
Yes.
So that 4 hour order block, it might buy back up into 4 hour order block, you know, we'll crap around. But when that 15-minute order block forms as a bearish order block, you can hop in that bad boy and it's going to smoke. And that's what's going to start your you know, your little price thing turning blue and your money going into, you know, showing up in the account. So that's what I mean by that's a grade A setup to me. Now, it's been times where maybe, you know, I was getting sleepy on London session and I had my bearish order block on the 4 hour and I might have put my trade in. But it wasn't a bearish order block on the 15-minute chart. So you get in the trade and it's going to bull crap. You know, it'll tick up, you know what I'm saying? It'll come down a little bit. It'll tick back up. You know, it's going to sell, but it's just not ready because it, you know, it hasn't started printing the order blocks on the smaller time frames and price hasn't started pushing in your direction. There's nothing wrong with taking that entry. It's just going to take you a little bit more time. You know what I'm saying? Is everybody tracking?
Yes.
There was a very good example of this yesterday, right? Did anybody see this bullish order block on UCAD yesterday?
No.
Huge bullish order block, and then for the next 8 hours, it didn't do nothing, right?
Mm-hmm.
So you could have entered on this 4 hour order block. You might be in drawdown if you didn't sell it back down, right? But if you enter for a buy after this 4 hour order block, it's not that you're wrong for doing that. It just, the lower time frame never said it was time to buy, right?
Oh, okay. Like the 15-minute.
Right. If you go down to the 15-minute, you got all these order blocks. They're bearish. Their price is just coming back.
Okay, I see.
And it's not to say that this isn't like, this is the order block right here. It's not that this isn't going to buy, but it just, if you had waited to get a bullish order block on this 15-minute, it would have been right here. So maybe you would have been in it for the last hour, right? There's your bullish order block, but it just crossed over your moving average. So this would have been a premature entry, but I mean, it's still a decent entry. It's a good entry, but this bullish order block, you know, would probably be the one that you would look for after this pulls down and taps in. This is the one you want to take to the upside. Does that make sense?
Okay, I see.
Hey, Todd,
So on the
Yeah.
4 hour, go ahead.
what about that bullish order block with the long green candle that does cross the moving averages?
This one right here?
There. Yeah. Was that before the 4 hour?
No, I mean, no, it was this is the 4 hour order block, right? But here's the thing. This is the tap in point. If you look at this 4 hour order block, if you look at this 4 hour order block, where do you want price to come back to?
To the golden zone of that green candle.
Right. You want it to come back here. So if you mark this up on your chart, you mark this up on your chart, then this is where you want your price to be. So when you go down here, you know this is premature.
Gotcha. Okay, that makes sense.
So, but even if you had took this L, you know, it shouldn't be a bad enough L to shake you. I mean, but you just understand, I'm not looking for a reaction until price hits my zone, right? So this would have been your first opportunity to get into the trade. Now, you could have been hesitant, you know, like Hope, because this didn't cross this line, and that's cool too. You just wait for your safer entry, which would have been after this order block, which the market closed on, so it didn't give you an entry. Y'all tracking?
What about the times where you're trying to get the entry, but it doesn't hit your golden zone at all, but
Yeah.
it's moving in that right direction?
What do you mean it's moving in the right direction?
Like it just doesn't
doesn't
come
pull
all the
back?
way back to the 50, or we're definitely looking for it to come back to the 50 or the 61.
So
And
listen,
if it doesn't, don't take it.
that happens. Well, that happens a lot. So here's the case. Here's the deal. Let's say we were waiting for this to this order block to come back and tap in, and it didn't. See how it just keeps going? So you have to decide as a trader whether you're going to take this trade or you're not. Because if you remember when we first started talking about getting tapped in on order blocks, I tried to reiterate to you guys, if you don't get tapped in, don't take the trade. Because in this case, price comes down, it gives you this low. It comes back and taps you in eventually, right? Then it plays around, then it wicks you out, and it goes right down here to this low. So if it doesn't tap you in, then don't get into the trade. Just wait, you know, for your next opportunity. Now, if you had waited until it came back up here and tapped you in, you know, maybe you would have got wicked out. I wouldn't have got wicked out. It would just activated my hedge before it went straight down to the lows. But you have to understand, first of all, where price is and the goal that you're trying to achieve. If you're going to take this trade, I'm not taking this trade. If it doesn't come to this golden zone, I'm not going to take the trade until it at least breaks this high and comes back and retest. You know what I'm saying? So maybe this is just going to be a shallow retracement that doesn't hit the golden zone and it starts buying. Once it breaks this high and retests, then I'll feel safe about you know, joining it and buying it up. But I'm a firm believer that these things pull back 50%. I've seen it enough times. That's my grade A trade. If it doesn't pull back 50%, then it's not grade A. It might be grade C. You know what I'm saying?
Yeah.
But the trades that I get paid the most and the easiest are the ones that pull back at least to the golden zone, right?
For the 61.8 at least.
Yeah. I mean, I say the golden zone. Anything after the golden zone is all gravy, right? Like, so if it goes all the way to the 78.6, which is the optimal trading entry, that's great too. But I'm just telling you, for me, from my experience, first of all, I would sell this down and I would sell it until it hits my golden zone. And then I need to see the rejection, and then I would need to see it react and pull away, you know? So this trade, you know, whenever I first saw the trade, and then Leandra even posted the order block, I really believed that we were going to get a pretty strong push up, and during the day Friday, but it just never materialized, and price just kind of fizzled out. I didn't sell this down either. We were I guess doing too much driving and all that stuff. I saw it, but if it had pushed down and started buying up, I could have just bought it and left it alone until the end of the day. But it just never materialized. So does everybody or who is still not comfortable on a grade A trade setup for them? So y'all are comfortable now. Selena, you're comfortable. Right.
Yes, I'm comfortable because there was something that, like I always ask you about the trade that doesn't pull back to the 50%. And I'm like, should I get in it? But now I know for a fact that if it doesn't pull back to that area, then that's just not that grade A trade. Keep it moving until it does.
You're right. And some of them aren't going to pull back, and they're going to go to where you think they're going to go. So if those interest you still, then you have to have a set of rules or some entry criteria that allows you to trade that. And for me, it needs to break this high, it needs to retest, and then it needs to take off. And I'm cool with it. Because some trades are just going to be shallow retracements. But for the most part, what you want to see is the trade that pull back to the zone and keep pressing. Those are the ones that pay you very comfortably.
I'm tracking.
Okay, so let's talk about your price targets. Like, does everybody know when to get out the trade? Selena doesn't.
Nope.
So this is a problem for a lot of traders.
So equal lows or highs.
Yeah, equal lows or equal highs, but which equal lows or which equal highs? That depends on what time frame you're picking your setups off of, right? So if you're taking your setup based on this 4-hour time frame, then your equal highs or equal lows will be based on the 4-hour time frame. So on this particular setup, if you're going to buy USD CAD, USD CAD is in a sell, right? It's not in a bullish move. This is a bearish move. Y'all agree?
Yeah.
Anyone? Bueller? So
Yeah, dollars dropped.
Yes.
yeah. So if you look at this weekly chart, you can see that this basically is in a bearish move. So any upward moves for me on USD CAD, I would treat them as retracements, right? And maybe I'll just measure from the top of this move down here to the bottom, and I need to see price come back to the golden zone, which makes sense because that's about the same level, right? So if I'm trading this up, I'm not looking to get more than price. Oh my God. So I would feel comfortable trading price to here or this the golden zone, right? Which might not be a lot of pips, but it keeps me safe. And if this is not good enough for you, right? If these 89 pips, between 89 and 100 pips, if that's not a good enough move for you, then you have to not take the trade because you understand that this is a selling, this move is selling. This is a bearish move overall. So maybe you wait till after that retracement and just sell, right? But that's a decision that you need to make, prior to you clicking the sell button or the buy button on this particular trade. Yeah, tracking?
Tracking.
Yes.
Can you say that again?
Okay. So we know this is a bullish order block. It closed above our moving average. I expect price to push up. But overall, I'm buying, I would be buying in the middle of a sell move, right? So if you're buying and the move is bearish, that's not always going to work out in your favor. Most trades that are lost because you're going against the trend, and the trend is clearly down, right?
Yes.
So you have to make a determination on whether you're going to buy in this selling market, right? And for the most part, if you don't know how to pick your take profits, then you should never do this, right? If you struggle with a take profit, then you shouldn't be buying right here, because where are you buying this to? I put this first blue line here because that's the low. We broke that low. You see, we broke this low. Now price should come back
Yes.
up and retest that area, right? So if you throw a fib from this entire down move to where it needs to come back up, it's going to be right above this low, you know, and probably in this imbalance area. So it'll go right there, and then it should continue to push down. But you have to be able to understand how to select your take profit areas, especially if you're trading against the trend. And all this is market structure. You know, we broke this low. I expect to see it come back and retest this low. So you can buy it right back up to that area, you know. And then you don't even have to get out the trade. You can just click the sell button and sell it down if it starts to sell, right?
Yep.
Tracking.
Okay, so knowing where to get in and out of the trades are crucial, especially your exits from the trade. You know, I think people are okay with entering a trade because they enter for whatever reason, but I think a lot of people don't understand where the exit from that trade is, you know, and that's when it's going to be important for you to understand where the market needs to go, right? So when I zoom into this, you know, I know there's market structure here, right? But for the advanced people, you also know that there's an imbalance in this big A candle. And this trade is going to go up and close that imbalance and then start pushing down, right? That would be the higher probability of why price even needs to come back up here, is to close this imbalance in this, you know, from this wick to this wick. Measure up 50%, it's probably going to be right here in your golden zone, right? That was the same golden zone that I used when I fib from here to here. Price needs to push back up into the golden zone. This is all confluence, right? First confluence is we broke this low and we need to come back and retest it. The second confluence is there's an imbalance. I mean, there's a 50% retracement right here. And the third one is there's an imbalance right here. You can throw all that stuff together and it gives you a pretty high probability that price is going to push back up here before it drops. But you should be able to do these things, you know, for each of your trades. Before you enter a trade, you should have, you know, a couple of different confluences that are going to help you to be successful. And you got to know your take profit before you get into the trade. Everybody's tracking.
Yes.
Who needs more help on that? All righty. So I want to stress this. Counter trend trades are not for everybody. In fact, they are quite dangerous, right? They're quite dangerous because anything can happen. Like, it's like going swimming in a lake. If you know that lake is flowing down into a river, or I mean, if you know this river is flowing down into a lake, when you jump in there, chances are you're going to get washed towards that lake. And in this case, the lake is going down. So, or the river is going down. So your higher probability for this trade is to wait until it gets to this area and wait for it to give you a sign that it's going to sell and hop in here to sell, right? Are y'all tracking?
Yes.
So if we shouldn't be so anxious to trade that you feel like, oh, I got to trade this up and down. I mean, I like to trade it up and down because it's a natural hedge, but there's a method to my madness. And if I know that this setup is happening at a time that I'm probably going to be asleep, then I'm not going to get in here to buy it up. I'll just wait because I don't want to fall asleep and it goes up and then it comes back down and I lose what I had, because I don't like to set a take profit in a trade. For me, that's a natural hedge. What I like to do is let it ride up and let it start coming back down, because then I just open up a sell position and I can close this buy position at any point. That's what I like to do. But you guys have to trade it how you trade it. If you're trading it straight up with a stop loss and a take profit, then that might work for you. The only problem is if you set a take profit and you go to sleep on a counter trend trade, it might not hit your take profit. It might get close and then turn around and blow your account, while you sleep. So I would not recommend that inexperienced traders take counter trend trades. This is a higher time frame, so maybe it will allow you, 4 or 8 hours, 2 candles, to get up to where it's going, but maybe it won't. Like I can't guarantee you that, and nobody else can guarantee you a time that it'll take to get to where it's going. So just be cognizant of that when you start taking these trades. And in your trading journal, when you're journaling your trades, you need to annotate that kind of stuff, because in a month from now, you start looking at your losers. Hopefully you're looking at your losers every week, but in a month, when you start going back and you look over your losing trades for that month, you'll say, man, I lost all these trades and they were all counter trend trades. So maybe you just stop counter trend trading altogether, and now you'll just have a collection of winners the next month. And that's how you build a program that works for you. A lot of you guys might be trading a program that I designed for me, but it might not be perfect for you. Maybe you have to tweak certain things about it, that help you out. Like for me, I'm not entering a trade in the middle of a Asian session. If I can't enter at the first Asian session, I ain't even doing it, man. I'm not. I'll wait, because most of the trades that I get upside down in or sideways are Asian session trades. Hedge is super activated during Asian because the price is all over the map. You guys have any questions? Bueller, anyone?
No, that was good, Todd.
All righty. So I know none of y'all FOMO trade. I know everybody has the if they lose 2 trades, they out for the rest of the week. A lot of y'all might laugh at those type of rules, but the people who actually follow those rules don't blow their accounts, because I don't know that there's been a week this past year where we didn't have a move ready when we came out the next week. Like we had some good moves set up for the next week. All righty. So I think Leandra brought up a good point about the JPYs and the dollar, right? So if y'all notice, if we look at the dollar, coming into this new year, we're bearish on the dollar, right? So we expected the dollar to fall this year. The dollar came off an extremely bullish run. We expect for it to fall back down. So if the dollar is collapsing, the JPYs will also collapse. You know, it kind of runs hand in hand. If the economy of the US looks like it's in trouble, the JPYs are going to be in trouble too. So, you know, just like the dollar is falling, the JPYs are falling, right? Does everybody understand that correlation?
Yes. Is this the weekly analysis now?
No, it's not. We're having a discussion.
You know, it's hard. I don't think I did. And maybe I shouldn't say this out loud and kept this to myself, because in my mind, I'm thinking that if the dollar is getting weaker, then the JPYs are the safer pairs to be in.
You said what, Selena?
No, never mind. Never mind.
No, computer bet.
Selena, I heard that.
You said what, Selena?
So what I was saying was, if the dollar, in my mind, I'm thinking if the dollar is weaker, and then so the safer pairs to be in will be the JPY pairs.
Well, yeah, that's true. But it's safer as far as selling. Yeah. It's nasty. But so I think you can put it in your mouth and then drink water if you want. But it's gonna be salty. What I think the important thing is whenever the economy is, or there's uncertainty out there, sell the JPYs. And of course, when we say sell the JPYs, it's actually people are putting money into the Japanese yen, right? So everything against the yen is going to sell, like AUD JPY, NZD JPY, all the other currencies are going to sell. So we say sell the JPY, right? It's actually
Okay, yeah, right,
selling those
right.
other currencies against the JPY. So the JPY is actually getting stronger. So that
Right.
is exactly correct. You know what you're saying. The analogy is correct. But when you trade the pair, you have to sell it, you know, instead of buying it, because there is no JPY USD or JPY anything.
Right, I got you. Okay.
Okay, so if the dollar is selling, what are the indices doing?
Buying.
Everybody should know that. Everybody should be able to answer that question. Yeah, they're buying. So so that should be a go-to for everybody on this call. We have to understand that the indices are going to do the exact opposite of the dollar. Right? Because if the dollar is cheaper, then businesses, you know, can get loans, and it's cheaper to get a loan, so your commodities will get stronger, right? Now what's going to happen eventually though is, you know, once the Feds create this recession, then they both might tank. You know, it shouldn't happen like over a long time period, but you know, you might see a week where they both go down. But you can see where basically the market was going up. We pulled way back. Now the market is right back above the moving average, right? On the commodities. So as long as the dollar is pulling back, these indices should continue to push up. And that should be your your go-to. Like, you know, you should understand that as a trader, and you need to look for buys in the indices while the dollar is weaker. I think last year when we first came into the year, we knew that those indices would be selling off. And I think that was kind of the theme, you know, for last year. And we got some good selling opportunities in those indices at the beginning of the year. I think the only real surprise was the Russian invasion of Ukraine, and that kind of screwed some things up. But to have your edge and understand what you need to look at trading, if you know these basic things, you know, like if the dollar is selling, the indices are going up, or if the dollar sells off, the JPYs are probably going to sell off. If you understand those rules, you always know kind of where to look for your trades, right?
Can we go back to the JPY dollar correlation and the selling?
Sure.
So when you're saying, okay, so all JPY, and if the JPY is selling, or they're dumping money into JPY, so I would be buying that for a sell, or that would be for a buy?
Okay, let's talk about this. Let's just look at USD JPY. Okay, so the JPY is strong right now. You understand that? That's why
Yes.
that's why you see it selling. What is actually selling is the USD, not the JPY. The dollar is selling and the JPY is getting stronger. So you see this downward move. Every pair that's paired with the JPY is going to be on the front of the JPY. So it's going to be AUD JPY, NZD JPY, you know, CAD JPY, CHF JPY. The JPY is getting stronger. Those other currencies are all selling. So you're actually buying the JPY when you sell USD JPY. You're actually buying the JPY. You're selling the pair, right? You understand that?
Yes.
But the JPY is what's getting stronger. So when the dollar is selling, right? When the dollar sells off, people are, you know, it insinuates that there's fear or there's uncertainty in the market. So the JPYs are going to sell too, right? Like any pair with the JPY in the back is going to sell when the dollar sells.
Okay. Got it. Tracking.
Okay. Now, here's something that's very important, because this used to happen to me all the time when I first started getting my understanding. A lot of times a news event will come out or something will happen, right? And I will know, hey man, if you know, if this CPI report is good, then the dollar is going to get stronger and the indices are going to sell. And the CPI report will come out and the indices will buy straight up, right? So you can't just jump in there because you think you know what should happen. And that probably should happen. But what happens a lot of the time is the day the news comes out, the market might do the opposite. The next day, though, it'll turn around and do what it's supposed to do. So my point here is you have to, just because you're biased, like if you look at this, this is a bearish order block. I'm biased for the sell. That doesn't mean that Sunday when the market opens, we just jump in and hit sell because I know it's going to sell this week. You have to wait for it to set up on the chart, right? Which means that price needs to retrace. It needs to buy up first, right? It needs to buy up to my blue line here because I've already fibbed this, but it needs to buy up here first and then it can turn and sell. It doesn't mean that it's going to buy up on Sunday and sell on Monday. It could buy up from Sunday to Wednesday. And then it can sell, it can hang out here Wednesday, and then it can sell on Thursday or Friday. Or it can just buy up all week and just hang out up here all week. And then next week it could sell. So we have to understand that we have a bias and we have an idea of what we would like to see, but we cannot control the time that it takes for it to play out, right? So don't be like me. When I first started noticing this stuff, I wanted it to happen like now. It doesn't always happen now, you know, just like that USD CAD trade that we looked at, that USD CAD chart that we just looked at from on this 4 hour. We got this bullish order block early that morning, right? Like at 9 o'clock, 9 a.m. it was a bullish order block. And then after that, it was nothing. It just, the trade ran off into the sunset. It never bought after that, because it'll buy next week at some point, but we have to wait on the move to actually come to fruition. You guys tracking?
Yes.
Yeah.
Yes, and we start at the 4 hour, and then we look down on the 15-minute to see if the 15-minute give us what we want first.
Yeah, that's exactly how I do it, and in the strategy that I detail. Now, this is important. If you trade the 1 hour chart, you can do the same thing. If you see a setup on the 1 hour, go to the 5 minute, get your entry. 2 time frames down, boom, boom. It works for everything, you know, in whatever time frame you trade. You know, if you trade the 15-minute and you see a setup on the 15-minute, drop down 2 time frames. Maybe you enter on the 1 minute or the 2 minute, you know. It works the same for every time frame. Drop 2 time frames down. You see your setup on 1 time frame, drop 2 time frames down. Now, here's the thing. If you're trading a 15-minute chart, your take profits are going to be a lot faster than your take profit on your 1 hour or your 4 hour chart, right? Your 4 hour chart, you might be looking at 100 pips. Your 15-minute chart, you might be looking at 20.
Yeah, that's true.
So don't get caught up in trying to stretch a trade out, you know, when it's already hit your TP if you're trading those lower time frames. Y'all tracking?
Yes.
Yes.
All righty. So
So for the second entry, you're just on like
no,
second
you-
before the
you're-
15-minute, you're just taking it down to the 15-minute.
you're confusing. You're confusing it. Even when you get your second entry, if you got your setup off that 4 hour, your take profit is going to be on that 4 hour, which is going to be your 100 pips.
Right.
Okay, right. That's what I thought. Yeah, that's
Your entry, you know, you get your entry on the 15-minute, that's not going to change your take profit. What I'm talking about is some people don't trade the 4 hour. They just trade the 15-minute. They see a setup on this 15-minute. So
got you.
that's when you get your take profit, you know, on a 15-minute setup. Okay, so hopefully, guys, hopefully y'all are spending some time doing your own homework and doing your own work on yourself. These psychology videos are great tools, right? But it's just not going to work in a timely manner for you if you're only doing it when we play it on Saturday. Like, you have to dedicate some time, you know. I don't know what your lives or your schedules look like, but you have to find some time to hone in on your craft on your own, right? Because that's what's going to expedite your learning. You know, like, we can give you everything that I've experienced, or you know, or Kim, or whoever's talking can give you the personal experiences that we have. But the truth of the matter is, if you don't take some of your own me time to go back and look at your trades or your charts, the way you marked up your charts, you're never going to come into your own, or it's just going to take a lot longer for you to come into your own as a trader, right? Like I can tell you until I'm blue in the face that this price is going to come to this imbalance and all that stuff. You have to be able to go back and look in your charts and see what price did at these, you know, in the past at these positions, right? And the way you do that is you go to the expansion. When the market expanded, you know, this market expanded down and it pulls back. Where is it pulling back to? You have to go take notes on that, right? When Selena posts these weekly order blocks, right? This is probably not a great order block because it's not long, you know, but when this price pulls back, where is it pulling back to, right? When I drop down here, where am I looking for this price to go back to? And how far do I have to drop down to see either order blocks or imbalances in my zone? Like you guys have to know that for yourself. I'm dropping down here on the 5 minute and I finally see some imbalance. The imbalance is right in my zone. So where do I expect this price to pull back to? When it pulls back, it can pull back to the order block in my zone, or maybe it goes and closes this imbalance that it left way back here in January 12th, you know, 2023. This was a weekly order block that was created last week. So who would have known that on last Thursday, as the price pushed down, that it was going to leave an imbalance, they would have to come back and fill. Maybe Tuesday, it comes back and hits this Tuesday before it sells off. But you have to know personally, like this has to be what you see. I mean, it's cool that I see this, right? That I can trade this. I see this and I can trade this up here. But it's not going to mean a hill of beans to you until you can start seeing this without me being here. Maybe you mark your own charts up, and then when we get here on the weekend, you can compare your charts to the ones that we mark up and see if they're similar, right? That's how you're going to grow faster, you know, as a trader. So hopefully everybody is kind of soaking in what they need to soak in order to become, you know, the traders that they want to be. Because the setups are working, you know. Several people are getting paid now off the trading setups. Now it's just you as an individual getting what you need to get to have a better understanding of what's going on. You guys have any questions over anything we cover? You know, the psychology part, understanding what your setups, what your grade A setups look like, any of that.
Todd, I have a, oh,
Okay.
go ahead, T. Is that T? I have a question, but go ahead.
Okay, really quick, when you say you fib that candle for your golden zone, you're talking about the weekly candle from the previous week.
Right. This candle right here.
That one red candle there from wick to wick.
Yes, I mean.
Oh, okay. Yeah. Okay.
I fib the direction of the candle, and that's my golden zone.
Mm-hmm.
Notice I did this before this call. Like this is already done.
Right. I see that.
Right. So that's all I did. I fibbed this candle. I marked up my golden zone. Now, me going down to that 5 minute, I didn't do that. You know, that was just me doing it as I was talking. But that's exactly how I find my areas of interest. That's exactly all I do is scale down. I drop down, and once I get into my zone, I need to see in my zone what's in my zone that's going to attract the price, you know, to hit. And you saw the imbalance, right? You saw the order block and you saw the imbalance, right? Did everybody see that?
Yes.
Yes.
So,
But show it again, Todd.
yeah,
So
please.
everybody can really see it.
Okay. This is the zone. Y'all saw the zone that I had marked up. In my zone, I have one order block right here. I have another one right here. And I have an imbalance right here. price can come and turn around at any one of these points.
Right.
More than likely, it's going to come to this imbalance. Oh, you piece of crap. Why did it put it way up here? Wow, it ain't letting me put it in the middle.
Hmm.
Okay, so more than likely price will come to this imbalance, which is cool. So if I'm buying AJ, you know, I'm going to buy with confidence, right? Until I get to my golden zone. And then once it hits my golden zone, I want to see if it's going to push to this area.
Mm.
So maybe if I take this trade, because, you know, of course, I'm a fib and get a pullback because price went up right here. It's going to pull back first. Maybe it'll start from right here and go up here. Now, once price gets here, you saw I'm already at 134 pips.
Mm-hmm.
Maybe it goes up and gives you 155 pips.
Mm-hmm.
You know, you only need 100 pips. Well, I keep saying that. I don't know what you guys need. I don't know if you're there yet, right? But in 100 pips, you should be able to get your 10%, right?
Mm-hmm. That's true.
You get 2 entries. If your entries are on the 15-minute,
Mm-hmm.
you know, I mean, you're going to get way over what you need. If both entries are on the 15-minute, you're going to get way over. But maybe you get an entry off, I don't know, a 4-hour. But to me, you should get probably an entry off the hour and then an entry off the 15-minute. And you'll get whatever percentage you need to get on the way up. But yeah, you're waiting, DC, you're waiting for your OB. You would wait, in this case, your second entry would wait for a bullish OB
Mm-hmm.
on 15-minute. So once this pulls back and gives you that bullish OB, then you'll get your position off this bullish or OB. Like, I want y'all, this is a 5-minute chart, right? We're just going to pretend that we were, well, actually, we don't have to pretend because it didn't give us an entry yet. So see all these bullish order block? There's a bullish order block is not tapped in. Here's a bullish order block. This one might be tapped in. Okay. Yeah, this one's probably tapped in. So we'll just say we got in right here. If this was your entry, I don't know why.
Todd, if you turn your magnet off, I think it'll allow you to adjust
Where's the magnet?
the highlighted icon to the left on your toolbar.
Why is it doing that? I don't like that at all. Okay, thank you. I don't know nothing about magnets. I don't know how I got a magnet lit up on my thing. But anywho, if you're taking this trade, pay attention. Look at where we're at right now. That's 10% right here.
Mm-hmm.
If this trade comes up, if you had taken this trade, that's 9.69 from here to here because you got in on the 5-minute chart. You only needed 47 pips to make 9% on your account, 9.69.
Mm-hmm.
So if you the smaller the time frame that you get in on, but you have to understand how to utilize your time frames, the better risk to reward you're going to make, right?
Mm-hmm.
And price is going to push all the way up to this level, right? Price will push into our golden zone. That's going to happen. Now, I'm not sitting here trying to teach you guys how to enter on the 5-minute or the 2-minute, even though you can do that. You can. The same way that we talked about going from the 4-hour to the 15-minute, you can do it from the 1 hour to the 5-minute, or you can do from the 15-minute down to the 1 or 2-minute. You can get those same entries during the same move, and you can make a heck of a lot of money. I don't teach you that. I'm just teaching you the basic way to get 10% because it's less of a chance of you getting lost in those lower time frames if you do it like we've been talking about from the 4 hour and then drop down to the 15 minute. I think multiple people have found success doing it this way. Now you can drop down to these lower time frames and make a heck of a lot more money, but you also increase the risk of this pulling back past where you entered the trade. And I don't want to create a bunch of problems with people who aren't experienced enough to do that at this point. But once you start seeing it, you can figure it out. Trust me. The same way that price left these imbalances, and we just talked about at the beginning of next week, we can expect price to pull back, right? Where's it going to pull back? There's all these imbalances in here. If you get lower, you're going to see imbalances that need to be filled. So the same way that price has to go and fill the imbalances on the upside, it has to come back and fill these imbalances. So it's going to pull back to somewhere, and then it's going to go further, and you can get entries down here or whatever. You can get your entries. So once you understand where you are in the move, then there's 1,000 different ways to skin the cat. Everybody tracking?
Yes.
Yeah.
Yes.
All righty. So we'll go ahead and put a bow on that session.
Let me just make, Todd, let me just make sure, got a quick question.
Okay.
Even though in the lower time frames and you see it pulling back, doesn't mean the trade is over. Still, the trade will proceed, correct? Because it's proceeding on the higher time frame.
That's correct. The trade is still going to come back here. The trade is
Right.
coming here. This is where it's coming. All you're trying to do on the lower time frame is get an entry to take it up there, right? So the reason why I stopped you at the 15-minute is because it's easy to explain, right? You get it on the 4 hour, you see your setup on the 4 hour, you drop down to the 15-minute, you get you an entry.
Right.
More times than not, if the trade goes 100 pips, you're going to get 10%.
Gotcha.
I mean, and that was the easiest way for me to explain it, without losing people in the weeds, right?
Right.
But you're going to get the pip count that you need if you do it exactly the way that video, that 10% video explains. You're going to get your pip count.
Okay.
Right?
Right.
Now, for those with the big brains or whatever, you can figure out from that video how you can drill down further and get you 5-minute entries or 3-minute entries. The same concept applies. It's just you're using a lower time frame. You already know where the trade is going. It's still going up here.
Gotcha. All right. Thank you. Thank you.
No problem. Anybody have anything else? All righty.